Have you ever wondered why two companies operating in the same industry can produce completely different outcome for its investors? Similar products, similar customers, similar opportunities, yet one creates enormous wealth for its shareholders and the other struggles. The answer often lies in the question, who actually owns the business and how it is structured. Because before a company becomes a stock, it is a business. And before it becomes a business, it begins with an owner, an idea, and a vision. And understanding that journey matters. Today, Indian stock market stands alongside some of the world's largest capital markets like the US and China, offering investors exposure to thousands of businesses across industries, sectors, and stages of growth. The opportunity set for investors is enormous, but not every listed company walks through the same journey. In fact, most listed businesses started far smaller than investors could imagine. A single idea, a single dream, a single ambition, a single decision, a single vision, a single conviction, a single opportunity, a single product, and a single solution. And over time, those humble beginnings evolved into businesses that we invest in today. Rather than getting lost in corporate terminology and legal jargon, today in Signal episode 32, let's understand the evolution of a business from an idea to an enterprise through the journey of Rasesh. Because every listed company has a story, and every story starts small before it becomes significant and substantial. Welcome back to Signal, where noisy markets meet simple, sharp, and sound insights for long-term investors. Let's go back to early 1990s. Meet Rasesh. Rasesh spots an emerging trend. He notices a shift in consumer preferences of snacking healthier. Believing this as an opportunity, he starts preparing snacks from home and distributing it to local customers. At this stage, Rasesh is the business. He buys the ingredients, makes the products, speaks to the customers, manages the orders, delivers the products. Every decision begins and ends with him. This simple structure is called sole proprietorship, where there is no separation between the owner and the business. If business generates profits, Rasesh benefits. If business generates losses, Rasesh bears the burden. And if business borrows money, Rasesh is personally responsible for it. The business can grow as fast as Rasesh's time, effort, skills, and resources allow for. As investors, we cannot invest in this business at this stage. However, it's worth noting and remembering that many of the listed companies began exactly this way. One person, one idea, and the conviction to pursue it. Whether it was Reliance Industries founded by Dhirubhai Ambani or Adani Group founded by Gautam Adani, there are countless businesses in the world who began the same way. And Rasesh's business was no different. As more and more customers discovered the products, orders increased, demand increased, new opportunities emerged, and with those opportunities, a new challenge began. Demand outgrew individual capacity. And to continue growing, Rasesh needed more than hard work and determination. He needed capital. He needed people, and he needed a structure that could support future growth. At this stage, Rasesh had two alternative pathways. The first pathway was to bring in a partner to share the responsibilities, the risks, and the rewards. Many successful businesses adapt this model and continue to operate as partnerships. And the other alternative was to establish a structure designed to support larger ambitions. A structure that could attract investment, bring in shareholders, and create a foundation for long-term growth. Rasesh chose the second path, and that decision became the first major turning point in the evolution of his business. To support the next phase of growth, Rasesh incorporated Rasesh Foods Private Limited. This was a major milestone. For the first time, the business became a separate legal entity. Rasesh was no longer the business. Instead, he became the owner of the business through shares. Family could invest, friends could invest, angel investors could participate. Ownership was now divided into shares, but those shares were private. They were not available for purchase on stock exchange. As investors, this stage teaches us a valuable lesson. Many businesses create substantial value during this stage long before they are publicly listed. Some of the most transformative years in a company's journey occur while it remains private. In the meantime, Rasesh's business gained momentum. New markets opened up. Business expanded beyond local customers. Commercial and corporate consumers started engaging. With every new opportunity, the scale of business continued to grow. But the growth came at a cost. Expanding operations meant more people, more capability, more capital, more infrastructure. The private limited structure served its purpose well. It offered Rasesh the foundation, the capability, and flexibility to expand the business. But as business grew, so did the ambitions. And soon a larger pool of capital was required. And the next stage in Rasesh's journey would fundamentally change who could participate in the growth journey. Over the following years, Rasesh Foods expanded across multiple cities. Revenue multiplied, customers multiplied, distribution networks expanded. The business had grown far larger than what Rasesh originally incepted. Yet the growth kept creating new opportunities, new factories, new technology, new markets, and each opportunity required additional capital. To prepare for the next phase of expansion, the company transitioned into a public company. This allowed ownership to be expanded beyond original founders and investors, enabling venture capital firms, institutional investors, private equity firms, and similar strategic investors to participate in company's future growth. The business was positioning itself to access larger pools of capital and support its future ambitions. As investors, one of the most important concepts to understand is capital fuels growth, and understanding why a company is raising capital often reveals a lot about management strategy and future ambitions. As business continued to expand, Rasesh Foods Private Limited required additional capital to accelerate its next phase of growth. The company therefore decided to invite public to participate in its future growth and invest in its initial public offering, or IPO. An IPO opens an opportunity for retail investors to participate or be part owners of the business. For Rasesh Foods, it was an opportunity to raise capital for future growth. And for investors, it was an opportunity to participate in company's future growth. So, for the first time, ordinary investors or retail investors or people like you and me would have an opportunity to be part owners of Rasesh Foods Private Limited. And following the IPO, Rasesh Foods Private Limited started trading on stock exchange and became a listed company. It needs to be noted that not all listed companies are structured the same way. Some are founder-led, some are owned by government, some are subsidiaries of multinational corporations, and others are professionally managed. Some founders continue to control or lead the company long after its listing. They are commonly known as promoter-led companies. The key question as an investor would be, will the promoter continue to allocate the capital wisely as they did before? And will they continue to create the long-term value of business? Some companies are owned or controlled by governments. In these businesses, investors would need to understand how public policy will influence the commercial decision-making. Some companies are subsidiaries of global corporations. Here, investors often benefit from established brands, global expertise, and mature governance structures. Others are professionally managed. Ownership and management are separated, and success depends heavily on leadership quality, execution capability, and organizational culture. And this is why two companies operating in the same industry can produce different outcomes for its investors. The structure influences decisions, and decisions influence shareholder outcomes. Every listed company has financial statements. Every listed company has a valuation. Every listed company has a share price. But before all those existed, there was an entrepreneur, an idea, a business structure, and a series of decisions that shaped the company into what it is today. So the next time when you analyze a company, don't just study numbers, study its journey. Ask who owns it, who controls it, how did it get here? Because understanding how a business is built can tell as much as financial statements themselves, or sometimes even more.